So, the most special keynote speaker this morning, Deepak Parekh, a man who needs absolutely no introduction. Deepak Parekh, Chairman of HDFC Asset Management Company, welcome to Perspectives 2023. We're looking forward to hearing from you.
Good morning, ladies and gentlemen. Hey, good morning. Thank you, Avinash, for inviting me today to be part of the Franklin Templeton Annual Client Engagement Perspectives 2023. I just want to remind you, many of you may not have been there, but I was invited on October 22nd, 1997, for one of these perspectives. It was called Emerging Market Conference, Transformation of the Economy. It was again organized by Franklin. So it was 26 years ago, and now I see it's 27 years. So, keeping with today's theme, Perspective 23, let me share perspectives of why I am here today. First, I have known Avinash since he was a little boy. And it is so gratifying to see how far he has come, helming Franklin Templeton, India's business today. I have to say, Avi, you certainly are a chip of the old block. His father, Deepak Satwalekar, was amongst HDFC's finest employees we've ever had. And he also played a critical and very important, crucial role as the first CEO of HDFC Life Insurance Company. Good genes apart, I can assure you that given my recent interaction with Avi, I am confident that Franklin Templeton, India, is back on a strong innings. The downside of my presence today is what is called out of perspective. Why I'm out of perspective? Because I understand Franklin Templeton in their past client engagements have had the glitz of glam quotient with speakers like Miss Universe, Bollywood actors, and other celebrities. I wish I had been invited to some of those sessions. But here you have called a retired old man today. The reason why I did not let go this opportunity to speak here today is primarily because I do believe that Franklin Templeton Asset Management deserves to be credited for the manner in which it has managed to tide over the crisis of April 2020. It was a period of heightened uncertainty in the midst of the lockdown, and some of the debt funds were caught in a bind of heavy redemptions at a time of acute systemic tightness of liquidity. It was a choice of the devil and the deep blue sea. Fire sales would have eroded value for investors, but closing the funds with the intentions of preserving the value triggered further anxiety amongst unit holders. It is very encouraging to note that all closed debt fund schemes have now paid back more than 100%. 109%, I think, to be precise, of the assets under management prevailing at the time of the winding up of the funds. I recall many of my friends had put money in the Templeton Mutual Fund, and they were desperately calling me to, what do? I said, just lie low They have good assets. At some day, you will get your money back. And actually, I did receive one call about 10 days ago, confirming the return of the funds. There are some. So let's see what are the critical learnings from this saga. First, always remember financial markets work on trust and confidence, only on trust and confidence. And that is why financial systems can be very fragile very quickly if there aren't sufficient liquidity buffers. So in the world of finance, one always has to be prepared for adverse and unexpected situations. Secondly, it takes a lot of courage to ride out the tough times. Yet what is important is staying unwavering to the tenet of doing what is right for the unit holders, what is right for your client. Thirdly, it is always better to endure short-term pain for longer-term good. That's exactly what you did in the 20s. Lastly, always be open and own up to unfavorable situations early enough in the day rather than brush things under the carpet. But transparency, integrity, and accountability go a long way in building long-lasting relationships. So kudos to the management of Franklin Templeton, who continued to believe in the India story and stayed committed to growing the business in the country. You are the oldest foreign asset management company. And you have a track record of 27 years in India and have grown both organically and inorganically. And credit must go to all the distributors, all of you, who have stood by Franklin Templeton through thick and thin. Mutual fund distributors are the lifeblood of any asset management business. Mutual fund in India is sold strongly, mutual fund is strongly, people rely on the reach and strength of distributors who remain the vital link between the fund house and the customers. In India, individuals today account for 60% of assets under management. 40% are institutional or NGOs, charities, but 60% of the AUM is individuals. Most individuals still prefer to invest through distributors rather than invest directly in the mutual fund. The statistics that I give you now are quite telling, that the share of distributors in value terms is 3 times more than direct investing in the top 30 cities of our country and 4 times more in smaller cities. So quite evidently, most mutual fund investors need the hand-holding that a distributor offers. As distributors, your hard work and perseverance has played a key role in making mutual fund a household name in India. I urge you to continue focusing on your clients' best interests whilst keeping ethics and your fiduciary responsibilities at the core. I am sure all of you will continue to take the mutual fund industry to newer heights and play even a stronger role in enabling more Indians to save and invest better. Today, India stands at a crossroads of change, transformation, and growth. This also resonates well, as this is the underlying theme of Franklin Templeton's Perspectives 2023. India has never had it better than now. I have worked in the financial sector for over 50 years now, and to my mind, the biggest change to the India story is that there was a time when India had to make efforts to take its growth stories overseas and try and convince the world of its capabilities, its reform agenda, and potential as an investment destination. India was often dismissed, saying its intentions were good, it had demonstrated capabilities as the back office of the world, but remained a fragile emerging market economy and was always in the mode of about to take off, but never really managed to take off. While things have changed dramatically, the change has been slow and steady for the better. The world's focus on India is now unprecedented. Investors want to invest in India as they recognize the real change on the ground and want to ride the wave of India's massive consumption story. With the right set of policy measures, India is now also being acknowledged as a competitive manufacturing hub. India's attractiveness for manufacturing is due to its low labor costs. Let me give you an example. These are 1921 numbers. The manufacturing wage in India in 2021 stood at 80 cents per hour. Lower than Indonesia, which was $1 an hour. China was $7 an hour, and Korea was $22.3 an hour. So we certainly have a massive advantage of labor costs. Even if they're going to double, we are still much better than other emerging countries. India's digitization success is also attributed to its competitive cost of data. Now, if one looks back at countries across the spectrum, 1 gigabyte of data costs 17 cents in India, only 17 cents, compared to 41 cents in China, 79 cents in UK, and $5.6 in the US. India's public distribution, digital infrastructure is an indigenous model, as you all know, which even developed countries want to emulate. Global companies now know they cannot afford to have India, they cannot afford not to have India as their key markets. I reiterate that this change that has happened is not overnight. It has been a gradual shift. But more important, the change has occurred on very strong, solid foundation. Reforms envisaged a decade ago are reaping benefits today. The best example of this is JAM Trinity. Today we have 50 crore Jan Dhan accounts, 1.4 billion Aadhaar cards, and 1.14 mobile subscribers. While I'm optimistic is that the ongoing reform momentum continues, but the difference is that the reforms initiated today are likely to reap benefits for India at a much faster pace than ever seen before. India has literally been over the moon, aiming for the sun, forging critical alliances with countries, has been host to G20, comprising of 85% of global GDP, and ranks amongst the top 5 countries in terms of stock market capitalization. Yet with all this euphoria, India is not immune from the vagaries of global macro environment. Global macro environment today is one of increased turbulence, is one of uncertainties, and is one of fragmentation. In the past 3 years, the world has seen a pandemic, an ongoing devastating war, and increased urgency owing to the impact of climate change crisis. The external global landscape is one of weakening global growth and harder financial conditions, with major central banks continuing to battle inflation and consequently resorting to raising interest rates. Rates which are higher are going to be higher for a longer period of time. The spillover effect of this is a cost of living crisis for a larger segment of the global population. In India, the consumer price index has been above the RBI's comfort level, but the RBI has managed to hold interest rates steady over the past 3 monetary policy announcements. August CPI inflation 6.8% is an improvement over the previous month. Food inflation is still high at near double digits, and food items have a weight in the GDP of 45%. A below par monsoon, a below normal monsoon after a period of 8 good years is staring at us, along with rising crude oil prices, which has hit over $90. Remember, we still import 85% of our crude requirements, and the days of lower crude oil prices are behind us. The question you may ask is, why is inflation so important? The answer is that inflation rate is critical because it erodes savings, particularly the savings of households. Globally, too, inflation is eroding consumer savings at the fastest pace in 4 decades. RBI may have tackled inflation deftly through monetary policy measures, and the government too has played its part in ensuring food prices are reined in. The reason the government banned export of wheat and the government banned export of certain rice, varieties of different rice, in order to see that the domestic prices don't shoot up. And it has also been able to import crude at the cheapest possible rates where feasible. But the bottom line is that inflation hurts the poorer segments the most. And countries have to prosper, they need resources to invest. And basic economics tells us that this comes from higher savings. So we need higher savings in India because these household savings are invested in the market, invested in infrastructure, in consumer, in bonds. Let's look a bit deeper at India's savings rate, which stands at 30% of GDP today. 65% of that 30% in India comprises of household savings. Now, when one dissects household savings, which is 19.6% of GDP, physical savings is 12%. But the net financial savings, that is savings excluding household liabilities, is only 7.6% of GDP. Financial savings must grow and will grow if India has to grow. On an optimistic note, bank deposits still account for the largest share of household savings. What is encouraging is that household investments in mutual funds are showing increased traction. The AUM of the mutual fund industry has shown tremendous growth from 8 lakh crores in 2013 to 47 lakh crore now. So 8 lakhs to 14 lakhs and growing. It is no wonder that the number of mutual fund folios have increased from 9 crores 3 years ago to 15 crores today. Moreover, the relevance of B30 or beyond the top 30 cities in India is also growing, which means that the mutual fund industry is able to attract money from smaller cities also. More than that, half of the new SIPs getting registered today are in fact coming from smaller towns, which is a remarkable achievement by the industry and its distribution network. So I remain optimistic that the pace of financialization of savings will increase. A young working population with growing income, increasing financial inclusion, digitization of the economy, and increased awareness about capital market products like mutual funds are likely to fuel financialization even further. Despite global volatility, domestic investors have continued to have faith in Indian markets. Domestic equity flows made our markets more resilient to volatility in foreign capital flows. For investors, for instance, last year foreign portfolio investors were net sellers, and it was the DII, domestic institutional investors, that continued investing. This year, the foreign portfolio investors have come back to India in a strong way, with year-to-date inflows of $17 billion, while domestic institutions are at $13 billion. That is the reason more money is going into the markets now. The key point is that mutual funds help to counterbalance the foreign portfolio investors when periods of volatility is a balancing factor. When foreigners go out, domestic institutions come in. While there has been a robust growth in industry, we still have a long way to go. India has more than 50 crore PAN card holders and more than 11 crore DMAT accounts, of which 6 crores have been just in the last 3 years. In contrast, the mutual fund industry has only reached about 4 crore investors, which points to a disproportionate headroom for growth. Mutual fund penetration in India has just crossed 16% of GDP, significantly lower than the global average of 80%. Globally, even in emerging markets, it's much more than 16%. India is the lowest amongst one of the large economies. Global average is 80%. So there's only one way our industry can go, and it's go up. In fact, low financial penetration characterizes most of India's financial sector. In our business, mortgage to GDP is 11%. In China, it is above 18%. In US, it's 52%. So again, in mortgages, we have not even scratched the surface. Insurance penetration in India is 4.2% of GDP against a global average of 7%. Life insurance penetration in India is only 3.2% of GDP, and non-life is about 1%. All this shows that the growth potential in India is enormous in future. So we don't need to worry about increased competition. There can be more mutual funds, but the market is so huge, the under-penetration level is so high that the market has to grow. So there's enough business for everyone. You can sell Templeton you can sell Templeton mutual fund scheme, you can sell HDFC mutual fund scheme. There are enough mutual fund schemes. There's enough business for everyone. The point I want to make is there's enough business for everyone. Yet mutual fund remains a push product without guaranteed returns. So the marketing, sales and distribution force is very critical. Most investors in India are not yet comfortable enough to choose a mutual fund scheme themselves. They need hand-holding, they need help. This is where your role is. So what will play a key role in deepening our penetration in the industry? First, we need more people like you. We need more distributors, be it individuals, national distributors, banks, special advisors, and the works. The community of registered distributors is about 120,000 only. Barely 30 to 40,000 are active. The rest are not active. So we need many, many more active distributors. Second, investors need to appreciate that as a layman, it is very hard to time the market. By this I mean individuals tend to be the most susceptible to peaks and lows, particularly in the equity markets. They rush in at peaks and lose their nerve on lows and end up selling. So while the returns on many mutual fund schemes over a longer period of time are high for retail investors, often he or she ends up getting the raw end of the stick because they bail out too easily. And this is where we need education. So deeper mutual fund penetration will also happen through more concerted efforts of financial literacy. And this is where you distributors play a very critical role. In an era of easy online access of information, or what is called the proliferation of the WhatsApp university, there is also a lot of misinformation and mis-selling, despite all the safeguards put in by the regulator. There are many ill-informed investors who start out with mutual funds and then abandon them thinking they can invest in the markets directly with a tip here and a tip there, only to end up burning their fingers. This is where your role as distributors is crucial in ensuring investors stay invested in the long term. Don't tell your clients today buy one scheme of a mutual fund, tomorrow sell a scheme and buy another one. Many distributors do that to earn higher commission, but you have to be loyal to your customers. So swapping schemes only improves your bottom line, but doesn't help the customer. This is also beneficial because the trail commissions earned also increases not just with longevity of the investment, but more so with mark-to-market appreciation on the investments. This is why the role of SIP, systematic investment plans, are so critical, and investors need to understand why it is important to have the discipline to ride through the waves, but also avoid entering the market if it's peaked. Monthly average SIPs across the mutual fund industries has been rising. Needless to add, we should not forget the history. It was Franklin Templeton that pioneered SIPs in India. The Franklin Templeton team needs to be acknowledged for their good work on the Franklin Templeton Academy, which is an initiative to support their distribution partners and instill infusion through financial literacy. I don't think any other mutual fund has an institute like that. FT, Franklin Templeton, is a strong brand, is a trusted brand. It is a global brand. It has taken its earlier setback in its stride and moved on. There have been many, many foreign asset management companies in India that did not have the tenacity to continue business in India. In fact, we at HDFC AMC are a beneficiary of having bought out Zurich AMC in 2003 and schemes of Morgan Stanley in 2013. To conclude, I think India's future is extremely promising, and so is the growth potential of the asset management business in India. I'm sure Frank Templeton will continue to make a mark in the industry and will grow from strength to strength, continuing its dedication to being customer-centric and leveraging on its strong distributor base like all of you, that it has nurtured all of you over many, many years. Thank you, and wishing you all the very best.
Mr. Parekh, thank you so much for those thoughts. Meaningful to the Franklin Templeton universe, insightful to everyone within and beyond. We thought we'd capitalize on the history that you and Avi share. So I'd like to invite Avi Satvalekar to join Mr. Deepak Parekh on stage, and we look forward to your conversation. Avi.
Wow, thank you very much. I couldn't have said anything better, and I am deeply appreciative of everything that you have done for the industry, for me personally. So I do appreciate you, and it's actually a special joy and an honor to be able to kind of pick your brain a little further on kind of what's shaping our country and broadly the financial services industry. So one of the things you said, and I think something you've said in the press as well as a little while earlier, is that you have never been more optimistic about India's future prospects. Now, you've been in the industry for a fairly long time, you said 50 years. What is it that's so unique this time around that has you so excited?
I think there are a number of factors that are going right. I don't see headwinds against India at the moment, which many countries are facing. Take, for instance, the global growth this year, 23. IMF projects the global growth to be 3%. India is 6%. IMF projects that in 2024, global growth to be 3.1%. India is 6.3%. So India is growing at twice the rate of the global growth. It has never happened in the past. And it's not just a flash in the pan 1 year, it is continuous. And as I mentioned, some of the reforms which the government undertook earlier are reaping benefits. We have total political stability. We have financial autonomy. We are self-sufficient in food grains. We don't go with a begging bowl outside to buy. In fact, we are exporting. We could export rice, wheat, whatever we make, because there's massive demand. Say, wheat prices after the Ukraine war in Europe increased 50% overnight because the wheat supplies came down in Europe because it was mainly coming from Ukraine. But Indian government banned export of wheat. We could have earned massive foreign exchange, but the domestic prices would have gone up. So in order to protect the domestic poorer segments of the society, the government rightly took a call. Let not export all the surplus wheat we have. Let us keep it in our warehouses, in our granary, and not increase the prices. So, some of these decisions they are taking, even take, for instance, revenue collection of government. Where have you seen every month GST keeps going up? And what was projected and what is it today? Direct taxes every year are going up by 30%. Direct tax rates have come down, but the collections have increased significantly. If you take foreign debt, India has the lowest foreign debt to GDP percentage. It is 19%. Our foreign debt as a percentage of GDP is only 19%. Most foreign countries, most emerging and developed countries are much larger. Take, for instance, it took us 60 years after independence to become $1 trillion economy. 1947, we became independent. We became $1 trillion company in 2007. In 2014, in 7 years, we became a $2 trillion economy. And very soon, in 2027, we will become a $5 trillion economy, and we'll be the third largest economy in the world after US and China. We will overtake Russia. We will overtake Germany and UK.
I mean, there's no doubt that
I can keep on giving you examples like that.
I'm sure. No, but I think you're right. I mean, I think there's been called, this is India's century, not just decade. Let me flip that around a little bit. Now, yes, the opportunities are there. The fact that there are a lot of external and internal tailwinds. And as you were saying earlier, there's no real headwinds that we're facing. So if you were to think about what can trip us up, what should we be aware of, what are the potential risks, how would you look at that?
See, I would say the biggest weakness we have is crude. Since it forms a significant part of our import bill, and it's already become $90, there's no justification of being 90 because the global growth is slowing down. So why should oil prices go up? But OPEC, and they want to protect their own receipts and their own income, and it's a joint decision of OPEC countries, and we are the sufferer. At one stage, if it's $100 or so, it's almost 40 to 50% of our import bill. One item, half our import bill is crude. So this is our biggest weakness. I'm not prepared to believe that India has no oil onshore or offshore. If Yemen, which is a crow flies, it is half an hour, Yemen has oil, why can't India have oil? We must have oil underneath. But we have not. You see, we had one company, ONGC, that had all the oil. Now you need, in a large country, you need 20 ONGCs to spend money on exploration, both onshore, offshore. And for many years, it was only a public sector domain. And ONGC was the only company that was exploring oil. So oil as a raw material is our weakness. Our second weakness is semiconductors. You require semiconductors in everything, television to air conditioners to whatever you have, radios and telephones. Now, you cannot remain a software capital of the world without having any hardware. We have to develop the hardware. We have to set up fab manufacturing units in India. We do not have the expertise. We have to buy the expertise. Large, credible group must come forward and partner with Samsung, Intel, Foxconn, whoever. But we need, because we cannot be, during the lockdown, Indian industry suffered because we did not have one small item. And so this is also our weakness. Then we have far from friendly neighbors. Some of our neighbors, when India prospers, they feel upset, so they start skirmishes on the border. So that is a danger. So we have these 2-3 crude hardware.
Hopefully the hardware problem will be fixed with the recent moves.
Yeah.
I think, when we look at global growth, and we've seen across the world, countries and economies that have done well, the propensity for expanding the inequality in income has been tremendously high. We've seen this in the US as well. We've seen this in parts of Asia, China. When you think about kind of how India's growth trajectory looks like, what are the things we should think about in terms of trying to curtail that and making this more of a inclusive growth?
No, if you see every economist, every government bureaucrat, politicians, everyone is only talking of inclusivity and how to carry the poorer segments of the people with us. The number of poorer people are reducing. And there are some numbers which I can't remember, but every year they come out with numbers. 100 million people are out of the poverty, who were below the poverty line have come above. So I think the consciousness is there. I think the resources you require are huge. For instance, this 5 kilos of rice or wheat is still being given to the poorer sections of. It was given during COVID times, but they extended it post-COVID also, and this system is still going on. Every poor person below a certain poverty line is getting his family either 5 kilos or 5 kilos of rice or 5 kilos of wheat. And despite this, our warehouses are full. That means that we are manufacturing much more food grains than we can consume. So I think inclusivity, then there are various government schemes. And in the housing, they had Prime Minister Awas Yojana, which was really an incredible scheme it worked for 6 years, where I tried to request the government to continue, but they said we don't have money. If a person is buying a house, 10% of it will be given by the government, the first 10%.
Wow, okay.
And you have to be on a certain area of the house, that's to be 400-500 square feet and things like that.
Sure.
But that encouraged housing, that encouraged poorer people to buy homes of smaller size. But they had it for 6 years, and our disbursements went through the roof.
So on the financial side, let's say as an industry, in order to promote that inclusivity, what do you think is the one kind of key thing that we should all be doing to help that? Or even accelerate that for some matter?
No, I think individually we all have to play our part. Hire some poorer people. We are giving 2% CSR. That goes to the bottom layer of the society for health and education. It is very heartening to note that the HNI community also are playing their part in India. May not yet be to the US levels, but it is incredible the number of HNIs who have supported new educational institutions, new hospitals and new schools. And so many new colleges set up only through philanthropy. And philanthropy, not corporate, but individual philanthropy and individual philanthropy. So, you know, even the culture of giving away money
Right.
is increasing. And I keep telling the younger people that first 20 years of your life you learn, the next 20 years of your life you earn, and the last 20 years you return. So you have to return what you earned.
Right.
You have to play your part, and if every individual does that, it'll be a different country in 5 years. Your poverty, you won't know where it went.
Perfect. Okay, I'm going to shift questions a little bit. You've seen how the financial services industry has evolved over the last 50 odd years. We're now coming up against a massive influence of technology across every sector, and our industry is no different, right? How do you think fintechs and that influence of technology will evolve and create either challenges or opportunities? And we've seen this multiple times in history, but curious to hear your thoughts around how it might look like now.
So let's start first with the startup ecosystem. We have the third largest startup ecosystem in India. And I think in last count there were 99 startups. Unicorns. Unicorns, they are massive unicorns. Over 100 unicorns are there out of 99,000 startups. Not 99, 99,000. Somehow or the other, they're getting funding. Government is concerned that foreign funding has slowed down for the younger people who have an idea who wants to do in tech. So they're trying to help through government institutions like SIDBI and others. So, see, fintech is not going to go away. Many people ask me, will they compete with banks? I think a bank needs a fintech and a fintech needs a bank. They cannot live without each other. You will see many banks buy good fintech companies, and fintechs will become part of the bank. RBI rules are quite stringent. Everyone and anyone cannot start lending.
Right.
Even if you see the payment bank licenses, when they issued payment bank licenses, many of them took the licenses, but they were so limited in scope that they surrendered it and they didn't start it. And one or two industrial groups who started a payment bank are regretting why the hell they got into this. Because you can't invest the money. You can only invest what you collect in government securities.
Right.
So that freedom to lend people want, to earn higher returns. That is not there. So fintech and banks have to work with each other and not against each other.
Right.
So far as digitization is concerned, we are on a massive plan. Every company you see the online purchases that are happening. And I just saw an ad yesterday where Titan has come out with a watch, where you just put the watch and it makes payment. You don't need to put your hand in your pocket, take your card out, take cash out. Just put the watch on the machine and it clicks. It's a Titan watch.
Wow.
I'll send you that video.
Please.
It's an ad of Titan which they've got.
Perfect. I don't know whether that be a security issue as well.
Yeah, if you
So I
lose
just
your
get
watch, you are in trouble.
Exactly. Well, right now, I think if we lose our phones also, we're in big trouble, right? One of the things that you've been credited with is being an incredible crisis manager. Right? You've been involved in and brought in as a consultant and as an advisor on a number of things, whether it has been kind of the Satyam rehabilitation, whether it has been NPS on the expert panel, on a variety of things, including IPL, which I'm sure was quite fun and exciting. Now, how do you, build a team? What are you looking for from a people perspective, from a quality perspective? Because you have had always an incredible group of people around you. And you've been able to lead that. So when you're looking at that, how do you look at bringing in somebody How are you looking at building that team? What are the qualities you're looking for?
No, first of all, when there is a crisis in the financial sector, the government forms a committee. You can't choose your own people. They will tell you, you have to be on the committee or you have to be the chairman of the committee. The other members, they will. You have no right. You can co-opt one or two with the permission of the government. So you're given a team of people, you have to work with that team. Like for instance, the first one, UTI crisis. Actually, part of the report was written by your dad.
Okay. I didn't know that.
I'm telling you, it was in all the UTI meetings were taking place in our boardroom or UTI, and with Deepak and I, we were discussing how to solve this issue, how to temporarily solve it. And he's a prolific writer. You come from a family of artists and writers and all. So I took his help, and he did a few paragraphs, a few chapters on the report, and we thought together, and then we gave the idea to the other committee members, and that's how it works. Like in Satyam, when I went there, the first thing, the company secretary, whom I didn't know whether I could trust him or not, I took my own secretary with me. He took me to Ramalinga Raju's room and said, "This is your room." I said, "I'm not going to sit in this room. I'm going to sit in the boardroom. I don't want to sit in Raju's room." And then we had a team of 4 of us. We said, first objective was, get the hell out of it as fast as you can. So what do you have to do? You have to protect the employees. You have to ensure your clients don't go away. And despite TCS, Wipro, Infosys, CEOs being close friends of mine, they set up teams to take away our business.
Right.
It's part of the business, how to increase business. So we had to continue calling every night American or European customer to say we are there. The same team is working on your job. Please have patience. You'll have a very good owner very soon. And so, you have to do at different ends. That time again, we had Chandu Bhave as the SEBI chairman. We had so many SEBI waivers, which we could only get because Bhave understood the importance of turning around Satyam, India's image as IT. Similarly, no one gave us money. IDBI chairman came forward when I spoke to him. I said, I can only guarantee that we'll try our best to give it back to you. But there was no money in the company. People had not been paid salaries for 3 months. Wow. Even the car that fetched me from the airport, that driver was complaining, 3 mahina se paisa nahi diya gaadi ka.
Oh boy.
So, it was such a bad situation. We needed money urgently.
Right.
And ASP.
So I think, you built HDFC.
We built HDFC.
Fair enough. I'm sure there was a team. Absolutely. But this was founded back in 1977 and it has grown. What are maybe kind of 2 lessons that you've learned in terms of building this behemoth that have helped you, and 2 things maybe that you wish you had done differently?
What would I have done differently? Let me say first. When we got the banking license, we didn't get the full support of our board. Because they say, you are a one-product company, you are in housing, what do you know of banking? Our board members were conservative. So we said, we'll hire the right people. Then we didn't put enough capital, and we gave 20% of our capital in the initial stages to National Westminster Bank, UK. Aditya Puri and I went to London. We met NatWest because it was a big bank not in India. Then we flew to US. Bankers Trust was not in India. So we met Bankers Trust. Then we came to Singapore. DBS was not in India. So we went to DBS. Both Bankers Trust and NatWest both came in together. But NatWest was first. So we took NatWest's money, gave them at par. 9 months later, they got into trouble in UK.
Right.
It's shut. The bank is not non-existent now. And the price was 70 rupees. We gave them at 10 rupees. And they came to us and said, we are in deep trouble. please buy our shares at 70 rupees. I said, am I an idiot to buy it at 70 rupees when I've sold it 9 months ago? So I said, no, we'll find buyers. So that's a big mistake. We could have bought it and see where it went.
Yep, absolutely.
But you needed that courage. The capital of the bank was twice the capital of HDFC. So even that was the objection of our directors. How you exposing this company, a strong company, and if it doesn't work, we will get into trouble. So all these issues were there. And so basically even in insurance, your dad was running it. We thought we didn't know insurance, so let's get a foreign partner. We got Standard Life. The only thing they did was make money. So, this is the lesson that we have. We don't have to rely totally on, in financial sector, you copy.
Right.
You come up with a product in mutual fund, next day someone else will copy it.
Sure.
There's no patent in a financial product. So you can train people in insurance companies. You don't have to give equity away. Equity is expensive and we gave it away. Yeah. That is a regret.
Fair enough.
What was the other question?
The first one was, what are the two things that really, in your mind, drove HDFC to become this massive financial services behemoth?
See, housing finance was not tested. There was no one giving individual loans at that time for housing. I went to the UTI chairman to request him to put money in our IPO. And he threw me out. He said, I have fiduciary responsibility. I have a fiduciary responsibility. And people are going to borrow and not pay you back. And I cannot risk public money in your equity IPO. That was the fate. So when we did a small IPO, it bombed. That time underwriters were there. It was a 100 rupee price. It opened at 80 rupees. So there was a 20% discount on day one.
Wow.
And the underwriters got it in their neck. And the UTI chairman told me, I told you so. 5 years later, UTI became the single largest shareholder of HDFC. Yep. 5 years later. So basically, some of these instances happened. We said what name to give to the bank. If we don't have a majority holding, how do you lend your name?
Right.
We had a 26% equity in the bank. And we are looking at new names. And we looked at Bank of Bombay.
Yep.
But then someone said, Bank of Bombay will be BOB, Bank of Baroda is there'll be confusion. So Puri pushed me to say, just call it HDFC Bank. And sort of I gave in. And there's no regret after all because, they kept all our name companies have performed. And there's not been, so that has not been that has not hurt us, the brand at least. Basically, all our companies in our group are dealing with money and customers. So you have to be prudent about managing money and you have to be prudent, customer-centric. You have to look at the customer first. We were so thrilled when we got a first customer who walked in for a housing loan. We put his photograph and his house, small house on our balance sheet. Cover of our balance sheet. Our first balance sheet is one borrower.
Nice. You were talking earlier in your speech about precisely the importance of being customer-centric. And let's take that in the context of our mutual fund industry. It's been around for a good 3 decades now. There are a number of things that the industry has done very well. And as we look at kind of the next transition, one thing that struck me as you were talking about it was the importance of our distributors and the importance of how they interact and how they help in that. I completely agree that we need more distributors. More active distributors. Now, how do you think as an industry or as senior leaders within the industry, what can we do to help drive and expand the number of distributors? Because the economics, whether we like it or not, like you pointed out, are getting harder and tougher. So we've got two conflicting positions. So what can we do to help drive that increase in distribution?
See, if you make it a little more attractive for them financially, they all will come forward.
I kind of walked into that one, didn't I?
But the regulator puts the brakes on. And
Right.
so we cannot pay more than what the regulator lays down. And I know some funds have got into trouble when they try and do other things.
Sure.
Now, in the past, they used to take we used to take the regulators abroad, supposedly on a study tour, and it was only fun and no study. And even HDFC Mutual Fund used to take without my knowledge. I didn't know. Once I caught them, because they took some 100 people to Bangkok, and Bangkok airport had a strike, so they couldn't come back. So they had to call me to say, can you please charter a private plane from Jet Airways or Indian Airlines and send it here so we can come back. So that's how I caught them, and then I stopped them from doing it. And then anyway, SEBI has now put TER, total expense ratio, and what have you.
Right. Fair enough. Maybe I'm going to shift a little bit to the personal side. Right. You have been an incredible mentor for...
Done and dusted.
You've been an incredible mentor for a number of people, right? Not just in financial services, but across different sectors. I want to ask you, who would you consider as your mentors? And kind of what are the one or two lessons that you took away from them?
I can say two people. My uncle and Keshav Mahindra. Keshav Mahindra was the first director on our board, because when Indira Gandhi was the Prime Minister, she started a company 100% government owned called HUTCO, which did with state finance companies and build homes. And she appointed Keshav as the chairman. So HTP, my uncle, thought that he has some knowledge of housing, so let's get him as a vice chairman.
Okay.
And I spent a lot of time with Keshav. And when he interviewed me, he had to be interviewed by him and by IFC. When he interviewed me, he says, why are you joining this new company? Come and work with us in Mahindra and Mahindra.
Okay.
But I really learned how to handle people, how to be humble, how to not lose your temper, how to be kind, because both of these gentlemen were soft-spoken. They cared for the poor, they cared for the people who worked for them, they looked after them well. So you know that these are the two people.
Perfect. Thanks. You probably won't remember this, but when I was getting ready to leave 27 odd years ago to go to the US and join Franklin, I'd come to you and asked you for advice, and you'd given me two pieces of advice. You said, always be humble, exactly what you were saying. Right? And the second piece was, go make sure you get yourself a professional degree, because your Sydenham BCom is not going to cut it. So keeping that in mind, right, what would your advice be to a number of the younger generation, or even the younger investors that are coming into our industry now? What would you kind of tell them that what are the one or two things that they should be thinking of and doing?
No, I think in this business of investments, patience is the biggest virtue. If you have no patience, don't invest in capital markets. So you have to give this story to your clients that this is a long-term business. This is not a flip-flop business. And, I must tell you an example that, as we used to go, Credit Lyonnais, CLSA, Jeffries, they used to take us to meet investors all over the world. And we used to go to the United States, and every year we had to go to Nassau because Templeton was there. And I had the privilege and honor to meet Sir John Templeton. And not once, but 2-3 times. And, he lived up to 94, 95 years old. And he had a picture in his room of Baba Amte. Baba Amte was a social worker in India who was empowering people with leprosy and helping people overcome leprosy. So somehow he had his picture. And the joke was that he was driving his own car, and so his secretary used to say, we used to run away when we see this big Impala coming into the compound, because at 94 also he was driving his car, he may knock us down or something. But he was such a genuine man, and he said the same thing. In investment, patience, patience, and only patience.
Absolutely
I remember that
true.
very clearly.
Very true, very true. Okay, I'm going to ask 2 more questions and then we'll kind of wrap it up.
0. Time up.
I know, but I'm going to sneak in 2. You've now you're still incredibly busy on all the boards, but what do you do in your downtime? How do you balance or rebalance yourself?
Playing bridge.
There we go. Good.
Doing Sudoku to keep my mind active.
Perfect. And then lastly, I know we've got a big gathering of our distributors. Any final words, thoughts, advice for them?
No, be sincere to your clients. There is a lot of money out there. As I mentioned, household savings are increasing. And most individuals now, when they see stock markets going up, they have aspirations to double their income, and bank interest doesn't satisfy them. Although, as I mentioned, bank deposits are the single largest source of household savings. But I think we need to get more individuals into the asset managed business. They will come, but to convince them and to offer them sincere service is your job. And you have to carry on that job. And regarding the payment, we have no flexibility because we are told how much to pay by the regulator. So the more you sell, the more you earn. The more money you bring into a mutual fund, the more you will earn.
Perfect. Thank you very much, sir.
It's a pleasure to sit with young men like you. It makes me younger.
Mr. Parekh, I'm going to hold you back for a second because Abhi has a gift and a money plant that he would like to hand over to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.